Yesterday's session really putting banking shares in the spotlight in a big way. What are you making of the value to be found in the banking space right now as a local investor? Because yesterday really saw a lot of foreign activity driving the sector higher.
Thank you for having me on your show. I think, as was expected, the banking stocks were due to come under pressure, especially after the very strong reporting season. What we tend to see is a lot of volatility around the reporting season, a spike up prior to the announcements and a bit of profit taking once the announcements are done, especially if the lines are generally in line with the market. So I think what happened yesterday is nothing new and nothing unexpected. And I guess we expect to continue seeing a bit of volatility, not only on the banking stocks, but across the universe of the Nairobi Securities Exchange listed equities.
Leading the charge yesterday was Equity Bank. It recorded a 4% gain and it sits currently at 18 shillings 30. It's up 7.3% year to date. What's your view on that stock specifically, Mbithe?
For Equity Bank, we are buyers of the name, and we still see a bit more upside on it. I think what we've seen for the last couple of days, actually, weeks, has been a lot of foreign investor interest for either KCB on one day and Equity Bank on the other day. The day before yesterday, there's a lot of traction on KCB. Yesterday, we saw more traction on Equity Bank compared to KCB. And again, what we're seeing in both names is a lot of foreign investor interest, driven essentially by the numbers that came through for last year, but also by, for the outlook of this year. I mean, despite the fact that there'll be slower loan growth and a slower deposit mobilization for these banks, I think the kind of retail clients that they operate with are allowing them to support their margins, regardless of the fact that there could be a mainstay on this and a backtrack on this if the parliament passes through its regulations.
Mbithe, it's very interesting because, you know, the two companies that are the focal points, as you've highlighted, Equity Bank and KCB, both pursuing very different strategies. I mean, we've got Equity Bank with focus primarily within Kenya's borders, and then KCB working hard at entrenching more of an African footprint. In the case of Equity Bank, do you see that strategy of operating within Kenya primarily as a good or a bad thing?
I think it's a good thing. The both banks are actually trying to follow up an African strategy, and I think for them, in as much as they're trying to diversify their revenue and earnings base to outside of Kenya with a focus on East Africa, it's important to note that for both of them, over 90% of their revenues, or even over 80% of their revenues, are coming from the Kenyan business. So the Kenyan business becomes a core, but what we are seeing is they're fashioning their businesses in the different regions differently. For example, KCB will position itself as a Pan-African bank and try to adopt to what Tanzania is doing, and Equity Bank is actually replicating its retail strategy in the countries that it's going through. So you have different competitive advantages for the different banks based on the kind of operational environment that they've been working on in Kenya.
I ask because KCB seems to be the clear favorite here. I mean, so far this year, it's up 27.6%, and that after reporting the highest 2011 pre-tax profit in the sector. On the flip side, we've got a player like Standard Chartered coming under pressure, and that on the back of the announcement that it would not be or would be reducing its dividend payout specifically. Fundamentally, though, how's Standard Chartered stacking up next to its peers?
I think let me just maybe focus a bit on KCB and probably try and elaborate why it's becoming very interesting. Last year, I think you must have had the phrase of the sleeping giant finally beginning to wake up. We're seeing a lot of efficiencies coming through from KCB. We're seeing the McKinsey reports that were done last year beginning to actually trickle through enhanced customer productivity, enhanced customer service. So for KCB, it has a huge asset base and it has an improving efficiency track record, which in essence can actually deliver huge growth potential for this company without even growing its asset base or even focusing on its deposit mobilization process. For Standard Chartered, the issue has been and continues to be the nature of its operations, meaning that it actually gets wholesale funding and then passes this on to corporate clients. The margins of this have actually been declining, especially up until sometime in January, February. Low liquidity, high interest rates from wholesale funding have actually meant a negative impact on the NIMs for such companies such as Standard Chartered. It still has a lower dividend, and it has actually paid a lower dividend, so the yield is not as strong as it was last year. So we're seeing a bit of a switch off out of this name because of a lower dividend yield and maybe lower profitability outlook from the expectations of the local players.
Mbithe, within that financial sector, very interestingly, we had British American Kenya posting a 1.7 billion shilling loss yesterday and hit by a fall in the value of its listed companies. This morning, TransCentury coming through with earnings having jumped 57% to 10.7 billion shillings, and this an investment firm as well. What do you make of TransCentury, given that we know it has been a very difficult investment climate over in the Kenyan economy?
TransCentury has actually reported very strong numbers, as you mentioned, 32% year-on-year growth on profitability. I think what's working in favor of TransCentury, it's the investments that it has been making over time. And if you're looking at TransCentury, then you probably may not want to compare it to British America, which has most of its investments listed on the stock exchange. For TransCentury, it's more of an infrastructure play. Its investments are in RVR. It has a 34% stake in RVR. It also has a stake in an engineering company. It's looking at electricity. It's looking at transformers. It's looking at oil and gas through its Civicon investment. It's also looking at consumer goods through its Chaibora investment in Tanzania. So you have a conglomerate of investments which are more skewed towards infrastructure, which actually means that you're positioning yourself in TransCentury more into the infrastructure space in Africa, which is something that you can actually get into directly. And it's actually worth noting and looking at. And I think what's most important for TransCentury today is more of its investments in RVR, enhancing capacity, rehabilitating some of its existing assets, just to push up and ramp up the amount of cargo that it can actually use on its on the current track that it has. And earlier today, I mean, I was able to go for the investor briefing, and the CEO was mentioning the way they're going to be pushing out an IT strategy. For example, putting up RFID on the trucks that they are using and on the wagons, which for instance means for you as an end consumer, you're able to track where your cargo is at, you're able to be efficient in terms of delivering on your promises, etc. Something which was not there prior. So it's more of unlocking potential and tapping into all this potential that the cargo opportunity offers for RVR through TransCentury.
Well, possibly part of the rationale for a company like British American yesterday announcing that it's diversifying into the real estate sector to improve its future performance as well. Mbithe, let's leave it there. Thanks so much for your time this morning. Mbithe Muema is Equity Research Analyst over at Renaissance Capital.